Imagine you sell a cup of lemonade today for $5. The customer promises to pay you next week. Did you earn the revenue today, or do you have to wait until next week? Believe it or not, the answer depends on which accounting method you're using. Today we're talking about cash accounting versus accrual accounting. And by the end of this video, you'll understand why most companies use accrual accounting. When businesses keep track of their finances, they need rules for deciding when to record the revenue and expenses. There are two main methods, cash accounting and accrual accounting. The biggest difference is simple. Cash accounting records transactions when cash changes hands. Accrual accounting records transactions when they are earned or incurred. Let's see what that means to the lemonade stand. Imagine a customer buys a cup of lemonade today for $5, but they don't pay you until next week. Under cash accounting, you don't record any revenue today. Why? Because you haven't received any cash yet. Next week, when the customer finally pays you $5, that's when you will record the revenue. With cash accounting, cash is all that matters. No cash, no revenue. Now let's look at the same exact situation using accrual accounting. The customer buys the lemonade, you already gave them the product, you already earned the revenue. So under accrual accounting, you record the $5 today, even though the customer hasn't paid yet. Instead of recording cash, you record something called accounts receivable. Think of accounts receivable as money customers owe you. Your journal entry would be debit accounts receivable $5 and credit revenue $5. Then next week when the customer pays, it'll change to debit cash $5 and credit accounts receivable $5. The revenue was already recorded earlier, now you're simply collecting the cash. Let's flip the situation now. Suppose you receive a bill for $20 worth of lemon, sugar, and cups. The supplier says you can pay next week. Under cash accounting, you wouldn't record the expense until you actually paid the bill. But under accrual accounting, you'd record the expense today because you've already received and used the supplies. But since you haven't paid it yet, you record something called accounts payable. Think of accounts payable as money that your business owes to someone else. The journal entry would be debit supplies expense $20 and credit accounts payable $20. And the next week when you pay the supplier, it changed to debits account payable $20 and credit cash $20. The cash was already recorded earlier. Now you're simply paying off what you owe. Again, accrual accounting focuses on when things happen, not when cash moves. Let's compare the two methods. Imagine your lemonade stand makes 500 sales in the last week of the month. Customers won't pay until the next month though. Under cash accounting, revenue this month would be $0. And under accrual accounting, you made 500 sales worth of revenue. So which one gives a more accurate picture of how your business is performed? Usually it's accrual accounting, and that's why a large company uses it. Imagine trying to run a company if you only looked at cash. You might think business is terrible one month and amazing the next month simply because payments were delayed. Accrual accounting matches revenue with the period it was earned and expenses with the period they were incurred. That gives the investors, managers, and lenders a clearer picture of what's really happened. Let's review. Cash accounting is recorded when revenue and expenses when cash changes hands. And accrual accounting record revenue when it is earned and record expenses when they're incurred. Cash accounting focuses on cash. Accrual accounting focuses on economic activity. So if someone buys your lemonade stand today but pays next week, cash accounting and accrual accounting will treat that transaction differently. That's why the difference is so important. It's one of the key ideas that separate basic bookkeeping from modern financial accounting. Thanks for watching, and I'll see you in the next video.